Good morning, everyone, and welcome to the Learn and Grow series. And let's welcome our special guest today, Stefan Svetkov. I hope I said your name right, Stefan.
Yeah, that's correct. Pleasure to be here, Vinky.
Yeah, we're super excited to have you with us today. And a little bit about Stefan. Stefan is a visionary founder of Realty Quant, a trailblazing company dedicated to bringing data-driven and quantitative techniques to transform the real estate industry with a profound mission to add value through education, investment, technology, and analytics. Stefan embodies the fusion of financial expertise and real estate innovation. Let me admit a few more people as they're coming in. And understanding the market intricacies is very, very important. I think crucial to all of us, and that's the reason me and Stephanie were thinking about, market analysis, how we should analyze the market, or how we should invest in the current market. And all of a sudden, it just popped up. Why don't we just bring Stefan to our bi-weekly meetup and then pick his brain? So because learning about all these marketing trends, it empowers us to identify the emerging opportunities and also the potential risk and the areas for growth. And by learning the inside out of the market, I don't know, for me, I think it's important because that way we can position ourselves to make better decisions and also better decisions for our investors. That's the reason we pick our topic today, around the ways of today's market trends. So let's dive into this current landscape of real estate market. Stefan, with your insightful perspective and the extensive expertise, I would say, and all the information that you're sharing with everybody on the LinkedIn, on the social media portals, we'll love to hear all about that and then see how that can help us today. Okay, Stefan, stage is all yours. So I'm going to give you the sharing session if you don't already have it.
Mm-hmm. Yeah, thank you, Vinky, for the very nice introduction. It's a pleasure to be here. I really like your work always. So I'm very, very happy to be here with you and your group. So let me share my screen. Just confirming, do you guys see my screen okay?
Yes, I do. Mm-hmm.
Okay, let me make this full screen. Okay. Yeah. So today's topic, the current market outlook. So a little bit about myself. So Vinky already introduced me. So I'm a multifamily investor as well. So that maybe wasn't in the bio. So I also operate multifamily assets, but I also run a Realty Quant, which is a data-driven real estate investing community. If you guys want to check our website, it's right here on this page as well. And in terms of, and I'm a financial engineer in my previous career, so I worked in derivatives trading. I studied quantitative finance at one of the leading universities, and I've presented topics on housing market and data-driven investing on various podcasts. So I hope you guys enjoy today's presentation. So yeah, disclaimer, so it's not for investing, and it doesn't constitute investing advice or recommendation. So yeah, so in terms of, I know Vinky mentioned how to go about analyzing different markets. So I will present my framework. So it's a pretty perhaps different framework than the usual fundamentals approach of picking markets by income, population, and housing supply. So it's a unique approach if you guys would kind of follow up with it and try to and just kind of let me know if you have any questions. So go over the methodology, the first part, and then I will go over where I see the current market as of today. So the methodology, so we'll go over the concept of market valuation, then momentum, and some interest rates discussion. And so market valuation, just a simple, it's a statistical concept. So again, I don't want to kind of make it too technical from the start, but really the idea of it is trying to identify some sort of deviation in current prices versus the fundamentals that real estate has, which are generally speaking income, population, housing supply. And so there are a few different approaches, regression-based, ratio-based, etc. But generally, the idea is that this kind of approach had predictive power versus previous recession declines, and it also has predictive power for appreciation. So it is very relevant to actually selecting markets in what I see as a better approach rather than just following where population is going. And so that's the methodology. So again, like that, it has relevance to downside risk. So this is a chart of 400 US metro areas at the global financial crisis, and it looks like a bumpy chart by virtue of having 400 points on it. Though in reality, like what you see is like in the blue line are what percentage overvaluation different metro areas had ahead of the global financial crisis, and then with in the orange line is essentially what their decline was, and those two were correlated almost 90%. So it's an extremely interesting circumstance and predictive power to have in real estate, because how can you get such high predictive power for something that's in the future or for something that's out of sample? So that is a very unusual situation. So going to like as to what leads to that essentially, and here it is at the state level. So the global financial crisis, and again, that's deviation of the current market versus fundamentals, and that's just as a presentation of the global financial crisis for different states. So very close alignment of what the overvaluation is of a market and what the subsequent price decline or potential price decline is in that market. So that now there is a bigger picture. Here's a lot of numbers, but essentially the picture is that market valuation ties to performance into the future for prolonged periods of time, such as up to a decade ahead. So here to the left is the 1990 recession, and to the right is the global financial crisis. And so 1990 recession is an extremely mild event, almost a non-event for real estate, and global financial crisis is a very, very severe kind of event. And the same thing presented in chart form, and I'll get back to the table, reveals the following dynamic. And so the dynamic being selecting markets by where they're valued, such as selecting undervalued markets pays off. So the concept of value investing pays off on the market side in real estate, in the sense that the green line here would be less than 0% undervalued markets. And then the dark blue line are like fairly valued markets. And then some of the other lines are essentially all different buckets of overvalued markets, where the light blue line is extremely overvalued, sort of over 40% overvalued markets. And so what this showed is that the under and fairly valued market consistently outperformed for 10 years ahead. And so it is a framework for where selecting purely by fundamentals is not a complete approach, because it does not account for the interplay of prices and fundamentals. And when that interplay is considered, such as here, you have a different circumstance for where for instance, in the left chart, like some of the markets along the lines that are underneath were actually very strong in fundamentals. Nevertheless, they declined. They performed very poorly for a whole decade ahead, in spite of being very strong in fundamentals. And so that's driven because of their prices were exceeding those fundamentals significantly, and so that is a dynamic. And so within my group, and I run a data-driven investment community as well. And so within that, the general goal is to pick markets only along the top two lines on the market side. So that is my approach to investing. And again, the reason is, even if you get a very strong economic growth, such as the post-1990 end of market cycle, you get a new market cycle 10 years ahead, strong economic growth, those markets outperform. And if you get a very negative scenario that I'm sure nobody expects now, but such as global financial crisis, then those markets outperform again. And so it's a very solid alignment. So in addition, in terms of, if looking at this table, and again, like going past that, it's a lot of numbers. So the first column is essentially how overvalued different metro areas were. And then there is like how much they declined and what was the decline duration. So one thing to observe is actually decline durations. They're very long generally in real estate, such as 4 to 6 years, but they are such due to overvaluation. And in the event there's no overvaluation, decline duration drops dramatically, such as to 1 year or less sometimes. And so that is another thing to consider. So it's a very different dynamic in terms of decline duration for differently overvalued markets. So now there's insight to that. I just want to bring some of the conceptual part as to what's driving that high predictive power of overvaluation studies. Now, if you think about doing something like this in the stock market, right? So in the stock market, something like this would not work. So why wouldn't it work? The reason why it wouldn't work is the stock market does not have autocorrelation. So does not have momentum, does not have trend. It's momentum. So this is a chart of market momentum. So the momentum on the bottom line is the momentum for the rental market, called. So if we were to take some, and the middle line, orange line, is momentum for multifamily, so commercial multifamily apartment complex assets. And then the top line is momentum for the housing market. So those are very different market dynamics in each of the three cases, where the housing market exhibits very strong momentum. So that's been something that's been studied since, I would say, the 1989 Case Shewar had a paper on market efficiency, and they tried to explain like this kind of positive momentum. Now, at the later point, in 2014, there was a paper by Guren at Harvard that explained about 2/3 of this momentum via via a model, a DMP model is called, that won 2010 Nobel Prize for Economics for friction. So essentially the explanation was that we have frictions in the real estate market based on how sellers set their prices, but using that model that helps us to interpret how those frictions actually lead to momentum 1, 2, 3 years ahead. And again, momentum is measured by autocorrelation. Here is defined as essentially the current year price growth correlating to the next year price growth, and so it's so essentially makes it that the market is forecastable. So once again, like in the stock market, that dynamic would be around 0. It has turned slightly negative with quantitative easing in the recent 15 years, but it's generally that the stock market is not forecastable. So a concept of where, if you would hear like someone say the stock market is overvalued, technically does not mean anything, because it's not predicting anything, like overvalued relative to what, and what is being predicted, like error forecasting specific declines or not, right? So that concept there does not exist. It also doesn't exist in the, or it gets mentioned, but it's sort of misstatement in a way, because it's not forecasting anything. And respectively, in the rental market, that concept, I would argue, does not exist. So like I put this chart some time ago to essentially show like where the rental market that exhibits very low momentum, so it means it has less frictions. It's less frictions than the actual transaction type markets, had extremely low predictive power for overvaluation studies. So if you try to say, for instance, like the rents, they really increased in like certain markets over the recent period, and that those rents are perhaps too high and maybe they should decline, as they actually did decline in some markets where they went too high. But the concept of where those rents are too high is not a meaningful concept. There is no concept of too high in the rental market, because the rental market does not exhibit momentum. Now, there is a concept of too high in the housing market due to momentum that exhibits and the resulting high predictive power of overvaluation studies there. And so that's like sort of a conceptual framework that leads, that shows essentially, or like indicates like where you can actually forecast stuff and understand the market. And now what's interesting is, so multifamily, so myself, I invest in multifamily. And so in multifamily, the predictive power is there. It is significant at around 77% for this specific recession, but it is not that high, not as high as the housing market. So multifamily is a little bit less predictive than the housing market. So again, just kind of sharing some of the fundamentals and some of the framework behind like what can help you kind of understand markets on a deeper level. And so another thing to note, so if we were to think that perhaps real estate markets have become more efficient in comparison to 1989 when Case Shewar wrote their paper on market efficiency, well, so this chart is showing that's not the case. So the top line is momentum or autocorrelation in the housing markets today, and the bottom line is actually before 1990, and it's more momentum now. And again, like the meaning of momentum being that you can forecast next year prices. So the market has trend, has momentum. You have like people that are investors are following each other and purchasing one after another in the same market type of dynamic. And so and so that's still there. The market has not gotten more efficient. So that's interesting. There is an interplay of overvaluation and momentum, where markets that have more momentum end up being more overvalued, and vice versa. So it's an interesting situation. It's kind of intuitive, but that has been the circumstance for the Sun Belt this market cycle, and I'll kind of get into that. So I'm just kind of putting some of the methodology kind of underpinnings, but that's what has driven to a big extent, in my view, the Sun Belt overvaluation. Another thing is, so how do we pick markets typically as multifamily investors? I'm guessing like most of the people in the audience, we pick markets typically, or most people pick markets by, okay, where is population, income, and housing supply? So in doing so we are sort of essentially, population growth has been, but those are all retrospective. So if population growth has been high and income and other components have been high or favorable, and so then we kind of extrapolate into the future, and we just internally in our brain we decided, okay, that market is going to perform well. So this is a fine approach. It has worked for investors for a reason, because it's a fine approach. But at the time when those fundamentals shift for whichever reason, there's no way to actually capture that. And also essentially what this is showing, that so this approach commits like a 5 times bigger forecasting error than an approach of simply following the prices. So even knowing nothing about the market, knowing none of the population growth, if one was to just open Excel and put some kind of forecasting of prices ahead and do that instead of trusting population and income and so forth, one would have committed a 5 times more forecasting error. That's another consideration. So that, again, that stems from momentum in the market, and I kind of again underscore that it's an important parameter to market dynamic and understanding the market. And so that's another thing. So I'll quickly touch on interest rates, and then I will get into where I see like the current market now. And so interest rates is another topic that's been a lot of discussion on LinkedIn and other places. So where if you have the 10-year treasury, or we have perhaps here the bond yields, like, so what are the rates on corporate bonds, for example, where they may correlate, or mortgage rates, etc. And with rising interest rates, perhaps cap rates are going to expand and so forth. So that's, as we have seen, it's not a one-to-one relationship in any way, but it's a more complex dynamic. So here in this chart are the cap rates for apartments, office, retail, industrial, commercial real estate compared to the BBB corporate bond rates. And so the correlation in this chart is actually very low. It varies by each of the 4 groups, but it's of the order of 20% and less. And so the corporate bond rates, if one ties to without adjusting for timing or anything, did not really correlate with cap rates well at all. Now that dynamic appeared to be different before 2008, when Peter Linneman, who is like a real estate researcher at Wharton, he had a paper where some of those rates were actually much more correlated, but they haven't been correlated over the past years. And so it's like very hard to say if interest rates increase that cap rates would actually expand. So that's one thing to say. Now, the caveat being there is a lag, significant lag in private real estate. So adjusting for the lag improves the correlation a little bit in this chart. I did that, though it's not a big improvement. And then, so generally it's difficult to map the two. Another thing for mortgage rates, similarly, like correlating mortgage rates with multifamily values is not entirely straightforward as it may seem. But picking deviation from a sort of historic trend of mortgage rates did correlate negatively with multifamily values. So that kind of deviation approach does correlate and does seem to have some predictive power versus like as for a decline in multifamily values. And cap rates, just the reason why, just this is again the foremost, but the reason why cap rates do not necessarily expand with interest rates is because cap rates, they're sort of an expected return minus a growth rate, sort of this R minus G thing here, which is expected return minus a growth rate of income, of your net operating income. And that growth rate, if that growth rate is removed, if there's no growth rate at all, for instance, for rent stabilized buildings in New York City, where I am, one could be picking what appears as significant deals as far as prices significantly dropping on the spike in interest rates. So rent stabilized assets are one example of multifamily assets that their cap rates expand or with a higher sensitivity to interest rates. Now, that said, considering that in this case, the interest rates increase was paired with significant inflation that boosted net operating income, there isn't necessarily a correspondent expansion in cap rates because the G here, the negative G or growth rate of DNY increases as well. And so in theory, cap rates could stay the same. Now they have been expanding to an extent and so forth, but it's not like accurate to say that the two are extremely correlated. And as we saw also for the relationship with bond yields or interest rates a little bit ago, it's actually not a very strong relationship. And so that's just the kind of some of the framework. And where's the current market? The current market now. So that's a chart. Not mean to kind of scare people. This more of the housing market where it has been. It's slightly changed, but it's not too different. Again, that doesn't mean that the housing market. And then I will move to commercial multifamily as well. So separate, similar analysis for commercial multifamily. Now the housing market. This is the history of 48 years of the housing market. So what's interesting is, during a lot of periods, housing market was, and that's how over or undervalued the housing market is compared to its fundamentals of income, population, housing supply. And so it's interesting that over prolonged periods of time, such as through the 80s and 90s, real estate was actually trading below its fundamentals, or the housing market was trading below its fundamentals. And it was trading below its fundamentals during the decline past the global financial crisis as well, through like 2017, 2018. Now, up to 2020, ahead of COVID, when I covered this same topic, actually it's today back then, my narrative was that the US housing market is fairly valued. It was fairly valued in beginning of 2020. Now that this changed, it should come as maybe no surprise with the excessive printing of money, it changed, and the housing market went close to 20% overvalued, which is very overvalued because technically it's the only time we've had it is 07. Now, again, that does not in any way indicate that there's going to be an event like 07 or anything like that. Having an event like 07 is a function of economic growth, and having extremely weak economic growth past 07, which is what happened then. But overvaluation is a measure of where your growth in the future may be hampered to an extent if not picking the correct markets. And so that's kind of what my company does, is to kind of like gear our community towards the right markets and also right deals and so forth. And so that's that. So here is the current housing market overvaluation in the top 10 most overvalued cities. So the count to the right is as of end of September. So those are the most overvalued cities. Again, those are exceptions. They're most overvalued. Many other places are fairly undervalued as well. But the leader has been Boise in Idaho. So Boise in Idaho, that was reflected by Mark Zandi at Moody's Analytics for the Atlantic University as well. And some, I'm trying to remember other sources and my company as well. And so that's, Boise's been consistently the most overvalued city so far. It's been coming down because its prices declined as well. And so currently it's at around 55% overvaluation. It peaked at 79%. And so it's been kind of like coming down. Its current housing price decline is, I believe, just over 10%. And then there's Tampa, Austin, Dallas, Charlotte, Phoenix. Those have been like the overvalued housing markets, if you will. So Austin, for instance, overvaluation has come down. So again, like some of the numbers that you see have been coming down. The peak is generally mid-2022 is the peak of those kind of normalized prices. So they've been coming down in most places now, not everywhere. But in Austin, as you can see, for instance, the 67% has kind of come down to 43, and it may come down to 20 and so forth. And again, it's not necessarily that it comes down through a reduction in the prices. It's also, if it stays stagnant for a long time, perhaps the fundamentals catch up and so forth. But the Austin price decline has been of the order of 15%. And so that has driven some of the, the big part of the decline. It's overvaluation as well. Now, what are some markets that are fairly or undervalued? Now, it's a very strange thing to speak of California cities such as San Francisco. Now, this is an interesting situation because San Francisco is technically undervalued, and yet it has been declining. That is an unusual, somewhat unusual situation, but actually not so much unusual because it's been declining on its fundamentals and sort of significant population outflow. And I guess what can be broader characterized as suburban trend and away also from like very expensive cities and so forth. But that said, if one was to look at it over a long time period, it is technically the most undervalued city out of top 100 cities in the US. And then there are other cities like, like Jackson, Mississippi, and Baton Rouge, Louisiana, and so forth that are actually in this list. Now, the thing here to consider is like often at this point in the cycle, markets that are undervalued, they're not the most attractive places we think of. This is natural, and then it may not be like so appealing like to invest and so on and so forth. But the reality is like they do have a kind of outperformance sort of built into their current prices that is expected for the future. And so that is something to consider and kind of weigh against like operational risk and other components. And so that's another chart that was kind of showing like how like the fairly valued markets, with some exception of New Orleans, but generally like have at the current period generally have around 0% decline. So it's fairly valued and undervalued housing markets at the moment are around 0% price decline. That's the case, for instance, in New York City or Jersey City or like parts of the Midwest and so on and so forth. Now, some of the overvalued markets, it's not the case. They have had some price decline. And so that's like just kind of trying to show it. And then also as far as outlook, then one can build forecasting models. And so here is like some forecasting for like 10 years ahead. And that those 10 years starting from mid-2022, because like I actually kind of mentioned before, like mid-2022 is actually seems to be an important point because that's the peak in normalized prices. That's the peak in prices normalized by fundamentals. So that's the kind of, in a way, real peak in some sense to some of those markets, it seems. And so for instance, if Austin that's a little bit old, this table excuse. So Austin is now around 15% decline, but that was the end of the second quarter was a 10% decline. And so, and so these are some sort of forecasted 10 years ahead appreciation in a super bad scenario and a very favorable scenario. So a very favorable scenario of strong economic growth does not appear great as far as investing in a city like Austin, because again, it has a lot of overvaluation that's built in. So 10 years ahead, favorable scenario coming at 11% higher than its 2022 peak, that is. And so that's another. Yeah, so commercial multifamily, again, like for many
Can I stop you for a second here, Stefan? I'm sorry, because I wanted to understand something for myself, or maybe
Sure.
everybody has a similar question. If you can go back to a couple slides, the overvaluation and the undervaluation. So this is the overall housing market pricing that you're looking at it, right? So not necessarily at the multifamily. So if I wanted to take this data and wanted to apply it to the multifamily, so how do I do that? How do I do it? And then looking at these numbers that you're sharing with us, the overvaluation or the undervaluation, how do we forecast going from here? And then how much low is gonna go or how much high is gonna go, or if we already hit the rock bottom. I mean, I have multiple questions coming to my mind, and I'm just putting out
Right.
everything so
Yes.
you can just
Yeah,
tell us.
no, those are great questions. So commercial multifamily here is here it is. So commercial multifamily, so it's different. The short answer is it's different, yes, than the housing market, but it's correlated, and it's kind of highly correlated. So it's not so the exact correlation. So this is how it looks. Commercial multifamily in like the more overvalued cities. Those are certain, like, I guess, like more overvalued cities, top 10 technically speaking, but it's a smaller data set. So commercial, as always, you don't get the most data possible from CoStar or other places. So so I have in the housing market, I have about 400 metro areas. Also, I have 2,700 counties. So it's a very rich data, right? In commercial, it's 25 cities, and I keep tracking 25 cities all the time. And so these are the top, more overvalued ones from those 25, and they've come down. Their overvaluation has come down versus the 2022 peak. So Phoenix, notably, now we've seen like some of the multifamily declines in Phoenix, for example. So Phoenix has come down in overvaluation to an extent. The caveat a little bit to multifamily is that SA was discussing momentum before. Multifamily has a little bit less momentum than the housing market, in whichever way it has apparently fewer frictions to how it's price set to its price setting mechanism. And so as a result of this, multifamily actually ends up how to say, like a little bit less predictable. And so this has predictive power. It's of the order of 77% was the one that I have for global financial crisis, but it is a little bit less predictive than the housing market, which I would say is like almost scientific, where they feel like the dynamic is like fairly easy to understand. But again, that's the overvaluation in multifamily. So it has come down. It has also come down quicker than in the housing market. So the same type of chart in the housing market, we've seen some of the numbers come down a bit, but not as much as commercial multifamily. There are reasons for that. Commercial multifamily adjusts quicker. And here's how commercial multifamily developed through 2020, and then the 2021, and then 2022, where the middle of 2022 was kind of the peak overvaluation. So that is sort of, well, I guess maybe a slight deviation, slight changes versus those numbers. They're almost exactly the same, slightly different data set. But this one is, this is where the overvaluations were at in the middle of 2022. And before that, it was like a much more fairly valued situation at through end 2020 inclusive. But again, then subsequently after 2022 middle, as seen here, then those numbers have come down. So that's kind of the dynamic in commercial multifamily, top 10 cities. How does that dynamic compare to the housing market? So here it is. So the 2022 peak to the left is commercial multifamily, then in this table to the right is the housing market. So they're different numbers. They're different numbers. The correlation of the two sets here is 82%. So they're sort of 80% correlated or whatever. But it's not the same. It's not the same. It's different numbers, and they also behave differently, it seems, in a kind of potential down cycle. They behave differently. And so, but the two as seen here, to the chart to the right, also how the chart looks, they're 82% correlated. So they're not entirely a different thing. And also keep in mind that their timing and adjustment is a little different. The true correlation may be even higher if one was to kind of adjust to the proper timing and so forth. This is some summary of the global financial crisis that shows some of the different dynamic between commercial multifamily and the housing market. So one difference is commercial multifamily has shorter decline durations. So decline durations in commercial average are about 2.5 years. And then which means, for instance, if now again, that those are only certain markets, right? But let's say certain markets like Phoenix and so forth have been declining since mid-2022. It's technically we're approaching 1.5 years into the cycle already. But on average, at least during global financial crisis, was about 2.5 years decline duration. and it is a way higher decline duration in the housing market. So the housing market decline duration is 4 to 6 years. So the housing market, if for instance, Austin is down 15% for 1.5 years, it's a significant decline for the extremely slow housing market. The housing market is extremely slow. And so it takes like 4 to 6 years. And it also takes 4 to 6 years if you have a very strong, easy event such as 1990. It's not because it's declining for so long because you have a very bad event like the global financial crisis. No, some of the previous charts that I were showing, actually a very strong economic growth event like after 1990, extremely easy recession, no issues, 0% decline for the general US housing market. And yet overvalued markets were declining for 4 to 6 years after. And notably, Hawaii had lower prices 8.5 years after 1998. And so those are like some of that's just kind of the dynamic. So it's a different dynamic. The other dynamic that for me is multifamily investor is a bit, as a multifamily investor is slightly concerning for multifamily in general, that I do not enjoy. In the housing market, if you have an undervalued market, that market is very unlikely to decline. Now, maybe it's also just the whole frictions and how slow it is and just the whole transaction and illiquidity and so forth. But in whichever way, the housing market, undervalued markets, they barely decline. So if you have in the global financial crisis, about 122 metro areas are actually undervalued even then, even in 07, and they decline an average of 6%. Now, so that's sort of this is a slight, okay, this is 9% for those 25 cities that are in this set. So the housing market declined, undervalued declined 9%, but commercial multifamily undervalued declined still a lot, declined 23%. And so there is a different downside risk profile for the two. So it appears that like price adjustment in commercial multifamily in a recession, a little bit contrary to where one would say, well, commercial multifamily is recession resistant. Well, maybe on the operational side, but on the market side, it appears a little bit less recession resistant than the housing market. So yeah, that's about it. So this is a link if you guys want to join, are interested in joining our data-driven investing community. So yeah, if you have any questions, let me know. I'm happy to address those.
Thanks, Stefan. I think this is a lot of information and a lot of kind of in-depth market analysis or market information. And I think this is a really, really good information. But again, it boils down to, you know, how to kind of find the good markets. And there's some markets too, you know, it's kind of an overall picture of the market, and the media as well telling us the overall picture of the market, right? The housing market is going up or going down, or is declining. So there's a fear in the market, especially in the investor base. So how do you address some of those concerns looking at the market? Because if I'm looking at your chart, you know, the one that you showed with us, the comparison with the housing market and the multifamily, I see multifamily is a little bit more stable than the housing market. It's not that much roller coaster right here. Go back. Yeah, that's going in proportional with the rental market as well, right?
You mean like this one here?
No, go back to where the chart is. Yeah, go back.
Here?
One more back.
Here?
No, back more. More.
I think multifamily is just those.
I think it was where you have those the graphs that you were trying to compare between the housing and the multifamily. That chart I was
housing and multifamily, these two slides, that's the comparison. That's the only one.
I thought there was one else where you have the rental income as well in there. You had the 3 bar charts.
Yes. So that chart, here you go. 1 second. That is,
yeah, this one I was talking about. See how I was looking at the rental market. It's kind of proportional to the multifamily, you know, and it's not that much roller coaster or that much not ups and downs like we see in the housing market. Compared to that, you know,
this one, you mean like this chart?
This chart, when you see the blue chart.
This chart actually slightly, maybe let me explain this one, because I don't want to confuse. This one is actually the this is the momentum only. So it's not like how stable on the downside or that way. it's that the housing market has more momentum than multifamily. So yeah, multifamily has less momentum. What this means is, what does this mean? It means multifamily potentially has fewer frictions. It also means that multifamily, though as a result of the fewer frictions, is a little bit less predictive. So that's it's a tricky part. So it's you know, it's just a little harder to predict. Predict in terms of to forecast stuff. Now, is multifamily more recession resistant as far as operationally? Yes, because of course you have you know, so many tenants in your asset and that. So there are benefits. I mean, it's a complex thing, right, to assess which one is better and so forth. In a recession. I mean, and again, like out of those things personally, I would say like the conclusion that I have for myself and where it's a positive scenario for people, just pick under and fairly valued markets and that's it. And you don't care about the market cycle. This is the conclusion. This is the real positive stuff, rather than having concerns or fears or anything about what's going to happen to the market. The old deals, let them be wherever they are, whichever market they're in. They've perhaps had their upside also in some ways, NOI and so on and so forth. So, but for new acquisitions, let it be like the green and the dark blue line here. And then if one does that, then one doesn't even care if the global financial crisis happens, because then you would perform, if you truly picked the green or the dark blue line, like this top, even if you got the global financial crisis, it would be a fine, not, you know, fine scenario, especially in the green line. But there are very few markets there now, unfortunately, but there are many markets in the dark blue line, the fairly valued one. So that's just the conclusion. So it's not where, oh, it's like a negative thing. I actually don't have any statement how much, let's say I have forecasting as to how much markets potentially decline, potentially, such as here. So let's say, or potentially appreciate. Like this left column is sort of like worst case, and then the right column kind of best case, sort of 10 years ahead appreciation, worst, best, this type of thing. But again, and similarly, I have it also for declines. So for the clients, let me try. I may have it also in some slides here. No, I guess I didn't include that one. But essentially, it doesn't. Whether we get the left type of scenario or the right type of scenario, it's just a function of economic growth. But the part that I want kind of people to stay with is really is really this chart. This is the most important chart for forward. That's as far as I'm concerned. It is the chart that says that essentially, if you picked under and fairly valued markets did outperform. That is the reality. That's the reality in real estate that happens. The second thing is the reason why that's due to momentum, which is charts like this. So that explains why this chart is so well ordered, why it actually functions like that. But that is the path forward, rather than, you know, be concerned. It's just like being aware of market selection at any point of time. And so also, as shown in like some of these some of like these slides here, or like, hold on, let me get to the commercial multifamily. So commercial multifamily was valued at very different levels at the different time points over a pretty short time period now. And so, and it has come down now from the 2022 period. So even a purchase now is perhaps, you know, potentially more favorable than one in the middle of 2022, as far as in those specific markets that have certain higher risk. And so yeah, so it's just the answer is selecting markets according to their fundamentals. If it's the housing market, there are many metros that are fairly valued. There are few metros, some metros that are also undervalued, but there are over 100 metro areas that are overall. Sorry, I keep jumping. There are over 100 metro areas that are overall in the green and blue line that are under or fairly valued. So there are over 100 metros that one can invest in that are perhaps great to invest over the long run. It is just having the understanding of market dynamic that some of the extremely popular metros now are actually a little bit more exposed to risk. And so it's also, in a sense, this dynamic, what it suggests is, if we think of where the Sun Belt, most of the Sun Belt, again, I don't want to say the whole Sun Belt because, again, so very specific. And to Vinky's point, also, indeed, there you have also all these super specific, every market is different. And within that market, if you're in a city, you have all those different neighborhoods and so on and so forth. That's totally the case. But broadly speaking, if we take like some of the bigger metros in the Sun Belt, so they would be along the lines of these lines here. That is kind of my expectation for where they perform. Again, that's not because I specifically don't like the Sun Belt. I actually like the Sun Belt. It's just because they happen to be at this level of valuation. So if we have, like here, places like Austin, Phoenix, Tampa, and Dallas that are over 40% overvalued at their 2022 peak, they would likely perform like this. And that is in a scenario of very strong economic growth. That is where the broad US real estate here declined 0%. The under and fairly valued market just kept chugging along and were unaffected and just did well. But that's the dynamic there. So it matters like where one picks a market, and that's really the value of having normalized prices and doing this kind of second order studies. Because looking at just like the first, where the price is, where the market is, and so forth, it does not give this picture, does not paint this picture. And yeah. And go ahead, Barb.
Thanks. Barb has a question. Barb, go ahead. Unmute yourself.
This is kind of overwhelming for my
No
non-graph brain, but two questions is, you said there's 100 markets that are under or fairly valued now.
Right. Yep.
How do we search out that data? Where is?
Right. So it's a good question. So it's a good question. I know that at the institutional level, Moody's has it. Moody's Analytics has it. Maybe you can search for the Atlantic University and study for them, and then you can go to our website and connect with me and schedule a call with me, perhaps, and we can talk about that. Generally, like here, let me try to open like a sheet for you, just like a very give me a second.
The reason I'm asking partially is
Yes.
I just started, I live in New Jersey, but have not been investing in New Jersey or New York, but recently we've been looking at multifamily in New York City. So these numbers make me very happy that I'm seeing here. So yeah, so I just kind of want to really be sure what I'm doing before, especially with the stabilization and other factors that I'm not.
Well, so see, yes, so multifamily, so the New York City housing market is actually fairly valued, right? So it's an expensive housing market that is though fairly valued. That's the situation. That's the situation, because the Northeast is out of favor this cycle. Nobody has wanted to invest in the Northeast. Now, that said, generally speaking, a few people, not nobody, but comparatively. But then now multifamily in New York City is kind of a different topic, because one, we have I think what I communicated on some of the slides, that the downside risk for some reason, even in under or fairly valued multifamily markets, seems to be there. So multifamily markets can decline even if they're under or fairly valued, which is totally not the case in the broader housing market. And then second, now you're dealing with rent stabilized assets that, to the discussion of cap rates, rent stabilized assets are the exactly the ones that their cap rates do increase with interest rates. And that stems directly from like kind of the theory of cap rates and what a cap rate is, which is that it builds in the expected growth of net operating income. And so I do not know, as far as rent stabilized buildings in New York City. I'm in New York City myself. I've been personally avoiding them now, so I don't know how to say. Now, just due to the risk, now they've gone extremely discounted. They are like really cheap. So they could be a deal, but I do not have an easy way to determine the rent stabilized specifically buildings. It's hard. That the housing market in New York City is, the housing market is is fairly valued, that is the case, and that I would not expect. And similarly, like New Jersey. So, for instance, I have also smaller properties in New Jersey in my personal portfolio. So in New Jersey, I have seen zero decline. There's been no decline, and I actually sold 2 properties recently over the past few months that both of them were at the high kind of like even like a higher price than it ever was, like sort of like setting a higher price than the market almost. And so that's like in the current market. So again, but that's because that's the housing market. That was something that fortunately is going the way I was expecting it in this circumstance, fortunately, so that there isn't going to be any decline, because those are fairly valued markets in that sense. But yeah, again, multifamily in New York City being rent stabilized is a big caveat there that complicates it due to the interest rates. That's what I'm trying to say. So it's not, I would not say it's extremely safe from a downside risk perspective, but the general housing in New York City is. Now, as far as if you're saying which metros are like undervalued and things like that, so that would be something like here. Give me a second. So
Fascinating.
Okay.
yeah, sorry. So that would be roughly, I don't know if I'm not able to when I'm on the Zoom to see how many, but I believe here it has like 95. Okay, it's about 95 metros. 95 from the roughly 400 metros are like under or fairly valued, and that's kind of the list. But if you'd like to connect, here is my,
Yeah.
I can give you my information and we can connect. Here, I'll put it on the chat. This is my calendar
do
link.
that.
Yeah, so this is my calendar link if you'd like to connect, discuss that direction more. But yeah, I mean, it's a good question. Who has it? I don't know if, other than at the institutional level, I don't know of somebody outside of my firm who deals with this data in the investing space. So that's the reality. At the institutional level, it's Moody's, it's Bloomberg, and it's and then the university in Florida. Those are 3 sources.
I think good information. Yeah, Stefan, really good information. I think it's a lot of data and a lot of information, and still need to wrap my head around it, So just wanted to come down to kind of pinpoint, what exactly we should be looking for. It's like a lot of data out of this, huge data, how we can just nail down to a few things that we can use when you're picking multifamily. But unfortunately, we're out of time. I have another event that's going to be starting in 3 minutes, but I would love to have you back to explore this further in another meetup. We can schedule one that we can dig deep, maybe a little bit more. But a lot of people are interested in you. If you can share your information in the chat for us, like how can people reach out to you? I know you put your Calendly link there. Any other ways I can connect with you?
Absolutely, yes. I put my Calendly link, and other than that, so realtyquant.com join, I guess, if they're interested in joining our community, and we will connect from there. And with that, they get an access to our data, and they also get an access to our investment community of other deal makers. So it's really general partner. It's essentially a group of general partners who do deals together following a data-driven approach.
Okay. Thank you. Thank you so much.